Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the MarketSite studio, we have Tony Seo, who's the head of regulatory strategy and innovation for anti-financial crime at Nasdaq. We're going to discuss what spoofing is and what regulators are focused on for 2024. Tony, it's great to see you as always. Welcome back to TradeTalks.
Thanks, Jill.
And your regulatory roundup, your monthly newsletter, you took a deep dive into spoofing this time around. And that's a classic market manipulation tactic, probably not a new word for our audience, but tell us more about what spoofing is.
So every month in the roundup, we do a deep dive into one form of market manipulation. So this month, we thought spoofing would be quite an interesting one. It's actually, as you say, it's a classic, but it's come into prominence again recently. So two former JP Morgan traders were sentenced to prison time, one 2 years and one 1 year, just the other month. We've had some kind of big fines lately as well. So HSBC was fined $45 million for spoofing. Just last week, a firm was fined $24 million for spoofing by FINRA, and it was spoofing US Treasuries. And then the actual behaviour is we're actually seeing more activity kind of globally. So there were, I think, 2 interesting spoofing incidents in Australia in the past year. And then it's not just kind of in the kind of like the treasuries or equities that we're seeing spoofing, we're seeing the actual regulatory focus expand as well. So ASA, which is the European power and gas energy regulator, they released some guidance on spoofing around kind of like wholesale power markets like electricity and gas. And there was like an interesting spoofing case in gas markets just the other month in Hungary. And then on top of that, anecdotally, we've heard kind of like a lot of discussion around spoofing in crypto assets as well. So it's something that we're seeing kind of not just in traditional markets, but we're hearing about it in kind of the new digital asset markets.
So what does spoofing behavior look like in practice?
So spoofing talks about a fairly kind of broad family of behavior. So essentially, it's about when someone puts in non-genuine orders, right? So they're real orders in the system, but they're not genuinely there to trade, right? For the purpose of basically creating a kind of like a fake representation of supply and demand. So I'll give you an example. So someone might put in a large number of buy orders, and it gives the impression there's like a lot of buying pressure in the marketplace. This would push up the price, right? And then the manipulator would sell at the higher price. And then quite often what they do is they would then flip the scenario. So then they would then take out those buy orders and they'd put in large sell orders into the marketplace. That would then push down the price, and then they would buy at this lower price, right? More kind of recently, kind of this behavior has become really kind of associated with kind of like algorithmic trading. There's techniques such as layering, right, where people use algorithms to enter in kind of fairly complex layers of orders at different price points to create this behavior, right? But it's kind of more likely for even though the spoofers themselves kind of using these kind of like algorithmic techniques, quite often the person getting spoofed is an algorithm on the other side, right? So they're actually creating these kind of fake situations that are tricking the algorithms that are in the marketplace. The actual behavior is quite profitable. So I think one of the landmark cases a few years back, the person made about I think $1.4 million in about 3 months of activity, right? And each of those spoofing cycles that person did, they lasted less than 300 milliseconds. So we're doing lots of these 300 millisecond activities, made about $1.4 million over 3 months. And then there's a more recent case where someone was essentially kind of hiring foreign traders and teaching them how to perform spoofing, right? And they had these kind of groups of traders spoofing the marketplace. And it was kind of reported one of these groups was making about $1 million a month, right, from their spoofing behavior, right? So it's fairly profitable. It's potentially quite disruptive to the markets because they're putting all these fake orders in, right? But it's something that's really quite even though it's a classic behavior, it is kind of very suited to the kind of modern trading environment.
As we close out 2023, many of the regulatory bodies are issuing their 2024 enforcement priority reports. What's the purpose of these reports, and why is it important for market participants to pay attention?
So it's fairly common for kind of like supervisors to release their kind of priorities in the coming year, right? The SEC, I think about a month ago, released their exam priorities. More recently, we've started getting a few more. And I think it's quite interesting, even if you're not kind of doing business in that specific jurisdiction to kind of see what's happening with these priorities, and it gives you an idea more broadly kind of what regulators are focused upon. So a couple of interesting ones that came out recently. There was one in Australia, so ASIC, the Australian Securities and Investments Commission. So they came with their 2024 enforcement priorities. And I think the new one for 2024 was around operational resilience and technology, right? So they're really going to focus in 2024 upon kind of like the operational resilience, not just of the kind of exchanges, the platforms, the market infrastructure, but kind of also the kind of like the participants themselves as well, right? Kind of similarly, kind of ESMA, which is the European kind of Securities Market Authority. So they came through with their 2024 work program as well. So they also listed technology as kind of one of the kind of key aspects of the work program, and they kind of broke it down to kind of 3 parts as kind of the new one for 2024. So the first part was around kind of like digitalization, kind of crypto, and this is kind of really kind of goes through what they've been doing recently with MiCA, right, and the DLT pilot, which is kind of happening in 2024. So there's going to be a lot of work around digital assets from ESMA in 2024. They also talk about operational resilience as well, just similar to ASIC, right? And they have the DORA Act kind of coming through, and that's being implemented in 2024, and that's going to be a big part of the focus and work program in 2024. And then finally, this is the first time for ESMA, they specifically called out artificial intelligence, right, as an area that they'd be looking at as part of this kind of like technology innovation kind of priority aspect that they talked about. And then talking about that as well, so FINMA, which is the Swiss financial regulator, right, they also released their kind of like yearly, what they call kind of risk factors, right? So they list out 7 risk factors, right? And this year there's been 2 new risk factors which they go through. One is around kind of like outsourced services, which is kind of like an interesting one, and it kind of goes to some of the things that the SEC and others have been talking about, where they're looking at these kind of like these outsourced services being potential risk areas, either from a cybersecurity perspective or even from a systemic risk perspective. If one of these outsourced services kind of takes on like a much broader role in the financial market ecosystem, right? So they talk about that, but I would say interestingly, they also specifically called out from a longer term perspective, artificial intelligence as something that they would be keeping an eye on and something that they thought would be impacting the kind of the marketplace from a longer term perspective.
Yeah, which is so interesting because you had mentioned earlier that you want to focus on the commonalities to understand how global regulators are thinking. And it seems to me anyway that AI is that consistent theme. Would you agree that that's one of the commonalities that they're focused on? And is there anything else that you would be calling out?
I would say emerging technologies generally is really the common theme in terms of like the kind of the new things that people are adding in, right? So if you look at artificial intelligence, I think is a key, right? And actually, it's kind of interesting kind of how that will play out. So with the way that FINMA talked about it, they talked about kind of governance, they talked about transparency, they talked about anti-discrimination, and actually Gensler just recently took a slightly different view, or not a different view, a slightly kind of interesting take, where he talked about AI greenwashing, or AI washing, which is similar to greenwashing, right? Where firms would essentially kind of like mislead in terms of how much AI potentially they are in their products or how much AI are in their investments, right? Since there's such a kind of like an AI kind of focus and boom at the moment. So that's kind of like a different kind of focus on that aspect.
Which is interesting,
as well.
like to your point with greenwashing, how do you quantify it, right? So what are the standards for that?
Right, and it is kind of like and I think it kind of goes to show that it's like we're looking at AI now, right, in terms of the impacts, and we talk about potential uses of AI, potential risks of AI, and I think those uses and risks are going to evolve over time as they're coming through, right? AI washing as a concept, I think we talked about it 6 months ago. I don't think it would be something that would have been in the public eye, right? But now kind of Gensler's kind of specifically mentioned it in the interview yesterday.
All right, we'll see what happens in 6 months. Appreciate the insight as always, Tony. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.